All right, John. Hi there. How are you doing?
Good, Jason. How are you? Long time no see.
Yeah, hey, it's been all of 24 hours. Um,
Lots changing.
yeah, and that's what's crazy. So thanks for doing this. Um, I had just heard that there's some changes being done to stress tests and a lot of things around that regarding the benchmark rate. So I was wondering, I guess, to begin with, can you explain what the benchmark rate is?
Sure. So when they introduced the stress test, they wanted to protect people against interest rate shock at renewal time. So they came up with this idea that they're going to pretend your interest rate is much higher than it actually is when you're applying for a mortgage. And that way they can kind of test whether you could survive a big rate hike at renewal time. So where they get the benchmark rate currently is it's the median of the big six banks' 5-year posted rate. Now, those rates, the banks don't use those rates when they're lending money. Nobody would borrow at posted rates. But what they are used for is to inflate your penalty when you break out of the contract. So it's something that the big six banks don't really tell you, but that's really where that rate is coming from.
Okay, perfect. So how can you just quickly explain how do they calculate then the payout penalty? You just mentioned that. So using the benchmark.
So typically what they'll do is when you took out your 5-year mortgage, let's say their posted rate was say 6%. Now 4 years later, you're breaking the contract. So they're going to compare that 6% to the posted rate of the 1-year term, which is when you're breaking it. And typically that's a very large difference. So that's where they get what's called interest rate differential, and they apply that to the amount of money you still owe over the remaining term. So what some of our other lenders do is they don't use that high of a rate to do the calculation. They use much lower rates. So in some cases, the penalty can be as much as half of what a big bank would charge you.
Oh, okay. So just completely off topic from where we're going, but then it's probably good dealing with somebody like yourself, a mortgage broker that has a wide range of options, because then the the person getting the mortgage is able to understand the different options that are there should they need to get out early.
Yeah, absolutely. So that's one of the things we talk about up front is, what are your plans for the next 5 years? Are you thinking of selling, moving? So we, depending on their situation, we try to build in as much flexibility as possible. And that goes with some of the restricted mortgages as well. They have slightly lower rates, but you have some restrictions. So if you're not moving in 5 years and you're not going to change anything, then sometimes those are better suited. But that's part of our upfront process with the customers to try to understand, not only what they're planning to do now, but what are their future plans as well.
Okay, perfect. Now we can get back to my original confusion. Basically, I think I had heard something where April the 6th, we were going to see the stress test change, or some of the way it qualifies, the way we qualify, how that changes. Can you do me a favor and bring clarity to what that was and actually the complete turnaround that we now have?
Sure. So the stress test itself isn't changing. What they were proposing to change was, instead of using that big bank 5-year posted rate, they were going to calculate a different rate. And that was going to be based on actual applications going into the insurance companies for a 5-year fixed mortgage. And then they're going to add 2% to that. So when they first announced it, 5-year rates were roughly 2.89. So add 2% to that and you get 4.89, which is much lower than the current benchmark rate. So all of a sudden people had more purchasing power. But one of the interesting things about the proposed change was they're going to change it every week. So all of a sudden, a week later, 5-year rates had dropped. So now you would qualify for more. This week they've gone back up. You would qualify for less. So it's going to be like a back and forth and back and forth. So last week, they announced that they're scrapping that whole proposed change to the way they come up with the benchmark rate in the first place. So that's now gone.
So they're scrapping the change that was supposed to occur April the 6th.
Yes.
And now they're proposing another change. Can you explain the change that they're going to do now and then when that's effective?
Right. So they're back to, well, they never left, but they're going to continue to use the bank's 5-year posted rate, the median, as the benchmark rate. Now, coincidentally, that has dropped or will be dropping on Monday from 5.19 to 5.04. So they're going to still use their old benchmark rate. It's just that's coincidentally also dropped. And that's where a lot of the confusion is coming from.
Okay, so what they're doing is they're scrapping the plan that we were expecting to come into the market April 6th, which was roughly going to allow the buyer to be able to afford 3% more home roughly. And so they're getting rid of that program all in its entirety. And then as a completely off, something completely different is the big 6 banks are changing their posted rates, which then give you a different benchmark, which is somewhat lower.
Yes, correct. Now,
and both announcements occurred at the same time?
Well, they overlapped. I mean, there's a lot of flux and change going on. But the stress test itself hasn't changed. So if the mortgage is insured, the stress test rate that they use to qualify you is the greater of the benchmark rate or your contract rate. So the benchmark rate is always higher than your contract rate, pretty much. So if it's an insured mortgage, it's going to default to using the benchmark rate. Now, if it's an uninsured mortgage, it's a slightly different formula. It's the greater of the benchmark rate or your contract rate plus 2%. So there are actually some unintended consequences that can happen. One of the reasons, if we remember, the reason this was introduced in the first place was to protect people at renewal time against interest rate shock. So if I'm thinking, well, I'm going to protect myself, I'm going to get a 10-year fixed rate instead so I don't have to renew as often. Well, if you take a 10-year contract rate and add 2% to it, it's actually higher than the benchmark rate. So now it's mathematically harder for me to qualify to get arguably a safer mortgage.
So it's pretty confusing. I guess the best bet is just to reach out to you guys and have a chat, discuss the different options depending on where they're at.
Absolutely. You know, our mission really is to educate people about mortgages and how they work. So that's part of the process. We are here to answer and try to explain as much detail as you're looking for, just so you can make the most informed decisions.
Okay, perfect. Thanks, John. I'll put all your contact info in the comments below, and appreciate you being there to answer these questions.
Anytime, Jason. My pleasure, and I wish you a healthy and safe weekend.
Thank you, and you as well.